Good morning, friends. Today we shall be starting with the topic of National Insurance Contribution known as NIC, Pay As You Earn, which is your PAYE scheme, as well as self-assessment, which basically means we'll be looking at the various genres of how tax is collected under the payee scheme and under the self-assessment scheme, and before that we shall be doing how contributions are made by employees, by self-assessed people, by employers towards their national insurance contributions. So first let's have a look at NIC. Now what is NIC to start off with? National insurance contributions are basically the contributions that is the income made towards the contribution for state welfare, primarily for the state pensions which the government then in turn needs to give back to its citizens. So each employee, each employer, each self-assessed person would contribute certain portion of his income towards this retirement planning. So what it is basically, national insurance contributions are collected to fund a variety of aspects of state welfare. In particular, state pensions is what we are talking about. Primarily, F6 syllabus would be focused on Class 1, Class 1A, Class 2 and Class 4 NIC contributions. So the only 4 contributions that we have to do for our F6 syllabus would be these. So let's start with Class 1 contribution to kickstart with. Now Class 1 contribution is basically made by the employer as well as the employee on the income of employment. So we're basically talking about employed people here. So employees themselves make a contribution. Along with the employees, the employers also make a contribution for the welfare, for the benefits of the retirement planning of the employees. So the income liable to Class 1 NIC is the gross amount of earnings from employment that an employee receives in cash and marketable cash assets. So we're talking about all the money that the employee receives in the form of cash and as well as good as cash. So basically cash equivalents as well. Remember, we're not talking about benefits here. We're only talking about cash and marketable assets. So something that can be easily liquidated into cash. So cash or marketable assets given instead of cash, which the employee can either use as if cash or is free to sell to obtain cash. Class 1 NIC does not apply to other forms of benefits or to reimbursed expenses. Now, primary contributions are due from all employees aged between 16 years and the retirement age. So, what do we know so far? Right, so we're talking about Class 1 NIC contribution, which as of now is on cash and cash equivalents. We do not include benefits in it. Now we are talking about primary contributions which are made by employees. As well as primary contribution, we also have got to look at secondary contributions. So let's deal with each of these contributions one at a time. So employees pay primary contributions on their earnings above the lower threshold limit of £8,060 initially at a main rate of 12% and then at a lower rate of 2% on earnings in excess of the upper earnings limit of £43,000. So very simply what it is, when I'm talking about my primary contribution, it is made by employees on their earnings. So up till the first £8,060, there is nothing that needs to be done. Between the threshold level of £43,000 and £8,060, employees are required to pay 12% NIC. And thereafter, above the threshold level of £43,000 2% NIC is taken from the employees as employees contribution, which is known as class 1 primary contribution. So what do we have here? Primary contributions are deducted from an employee's gross pay itself. They do not rank as an allowable expense for calculating the employee's income tax liability. So you have to pay tax on your class 1 contributions as well. Why? Because it is definitely a part of your salary. It is a deduction from your salary itself. Now what about secondary contributions? Primary contributions we know are made by employees between the threshold level of 43,000 and 8,060. Primary contributions are deducted at 12%. Above the upper threshold level of 43,000 pounds, primary contributions are deducted at 2%. What about class 2 contributions? Now, secondary contributions. Secondary contributions are due from employers. So employees themselves contribute towards their state welfare, that is pension, in the form of primary contribution, class 1 contributions. Employers, on the other hand, also contribute a part towards the state pension of their employees, which is known as class 1 secondary contribution. They must pay to all employees above the age of 16. There is no upper earnings limit, and one contribution rate of 13.8% applies to all earnings above the lower limit of 8,112 pounds. So very simply, what do we have? We now are looking at secondary contributions, which are made by employers. Employers make secondary contributions above the threshold level of 8,112. Till 8,112, nothing is paid. Above 8,112, a flat rate of 13.8% is deducted from the employers as class 1 secondary contribution. So very simply, till the threshold level of 8,112, nothing is deducted. Above the threshold level of 8,112, primary secondary contribution class 1 is deducted at 13.8%. These contributions rank as an additional wage cost to the employer. Definitely what it is an additional wage cost to the employer. They attract income or corporation tax relief as a trading expense. Why? Because this is definitely another additional expense which the employer has to make towards the benefit, towards the welfare of its employees. Both primary and secondary contributions are collected through the pay as you earn system. So what is this pay as you earn system? Pay as you earn means as soon as you earn, you're supposed to pay this contribution. So very much similar to what we know as tax deducted at source itself. All contributions are collected on a weekly or monthly basis for the tax year. However, in our exams, we will assume it to be an annual basis always. The rates which I just told you are given to you in your rates and allowances sheet. So even if you get confused, always please refer back to your rates and allowances sheet. Next, let's do class 1A contributions. Class 1A contributions are payable by the employer only and are based on the value of taxable benefits. So very simply, what we know now is that class 1 is paid on cash and cash equivalents. Both employee as well as employer make contributions towards class 1. Employee's contribution is known as primary contribution. Employer's contribution is known as secondary contribution. Now let's proceed to class 1A, which the employer only pays on the taxable benefits which the employee receives. So very simply, what we have, class 1A, again a tax, again a NIC contribution made by the employer on the taxable benefits paid out to the employee. Tax exempt benefits are liable to neither Class 1 or Class 1A NIC. Why? Simply because they are tax exempt. Determined using the annual rate of 13.8%. The liability is paid by the employer through the pay-as-you-earn scheme by the 22nd of July following the end of the tax year if you're paying it electronically. So very simply, the flat rate is 13.8% here. No starting threshold level. There is a flat rate of 13.8%. So very simply, what we know so far, let's quickly recapitulate. Till 8,060, there is nothing. Between 43,000 to 8,060, primary contribution 12%. Above 43,000 pounds, it is at 2%. This till the threshold level of 8112 is nothing. Above the threshold level of 8112 is a flat rate of 13.8%. Class 1A, however, is always a flat rate of 13.8%. Let's quickly do a quick example on this. Right. Mr. Dexter is an employee who earns an annual salary of £47,000 throughout 16-17. In addition, he was provided with the following benefits. Calculate Class 1 and Class 1A contributions. Very simply, Class 1 is paid on cash and as good as cash. So what do we have? We've been given the level of £47,000, which is received as cash or cash equivalent. So let's have a look at the primary contribution first. So what do we have? Between 43,000 and 8,060, contribution is made at 12%. After therewith, so what is beyond 43,000? You've got 47,000 minus 43,000. NIC is paid at 2%. Very simply, 4193 plus 80, which comes out to be 4273 in total. That is your primary contribution. Secondary contribution to start off with is over and above the threshold level of 8112. So you've got how much? You've got 47,000 minus threshold level 8112 paid at a flat rate of 13.8%, comes out to be 5367. Apart from this, you also have Class 1A, which is paid on benefits. Benefits equal company motor car 4,000 and car fuel 3,760. Thus, the total value of benefits is 4,000 plus 3,760 paid at a flat rate of 13.8%. Simply, it is 1,071 pounds. So nice and easy, as long as you know the upper threshold level, as long as you know the rates. Even if you don't know, you can always refer to the column of your rates and allowances sheet. But you should know what to include in Class 1 and what to include in Class 1A contributions. So let's get back to the rules. Class 2 contributions, these are payable by self-employed persons aged between 16 years and the retirement age, is always paid at a flat weekly rate. The applicable flat weekly rate is 2.80 for 16-17. Please read this as 16-17 is 2.80, which would again be given to you in your rates and allowances sheet. Actual payment to HMRC is under self-assessment system and is due in a single installment by the 31st of January. So which basically means 31st January 2018 for 16-7 contributions. Arrears of Class 2 contributions can be collected via pay coding system if the individual is now an employee. So very simply, what do we have? We now have class 2 NIC contributions, which are basically paid by self-employed people at a weekly flat rate, which is 2.80 per week. So very simply, what we have for this, we have us for self-employed people collected under pay as you earn. It's at a weekly flat rate, which is 2.80 pounds. What else? What about class 4 contributions? Very simply, it is payable by self-employed persons between 16 years and the retirement age. The liability is calculated on an annual basis by reference to the amount of tax-adjusted trading profits assessable for the relevant tax year. So what do? We have to look at the adjusted trading profits. So we're looking at tax-adjusted trading profits, which are paid at a main rate of 9% for profits between 8,060 and the upper limit of 43,000. Thereafter at 2%. So rates would again be provided to you in the rates and allowances sheet. These contributions are collected by the self-assessed income tax liability of the taxpayer, which is usually paid under 3 installments. So what do we have? We now have class 4 contribution, which is again paid by self-assessed people based on the adjusted trading income. The same threshold levels as class 1. So nothing till 860. Between 43,000 to 8,060, you have a percentage limit is just the change. It is 9% in this case. Above 43,000, it is the same 2%. So everything else remains the same. Just for self-employed people, you have class 4 instead of class 1, and the applicable rate is 9% instead of the original 12%. Let's have a look at a quick question. Right. Mr. Cowdrey has been trading since 1993. His adjusted profits for 16-17 are £52,000. We simply have to calculate class 2 and class 4 contributions. Now, class 2 contribution, we all know, is a weekly flat rate, which is 2.80. We have 52 weeks, thus it is £146. Class 4 contribution is made depending upon the adjusted trading income above the threshold level of £8,060, which is £52,000 is given to you. So between £43,000 and £8,060, you would be paying at 9%. Thereafter, above what is 52,000 is your income above the threshold level of £43,000, on which you pay at 2%. So which total comes out to be £3,325 to be precise. So very simply, what we have the simple class 2 and class 4 contributions which are made and thus collected by under self-assessment scheme by the self-assessed people. So very simply, class 4 and class 2 along with our class 1 and class 1A we've done. Now, apart from this, the only thing remaining in your NIC is your annual employment allowance, which means each employer is entitled to reduce the amount of employer's class 1 NIC payable to buy up to £3,000 for the tax year. This claim is made through the payroll software used by the employer. Employees' contributions and employers' class 1A contributions are not affected by this allowance. However, what it is, class 1 NIC payable is adjusted. The employment allowance is no longer available if a director is the only employee with earnings subject to class 1, which is more than 8,120 112 pounds, very simply, per annum. So that is your annual employment allowance. Now that we've done our NIC portion, let's now begin with your next topic, which is about pay as you earn, which is a system of collecting tax. It is very much similar to, like, we have TDS in India, which is tax deducted at source. So what it is known as pay as you earn. So as soon as you earn, you paid the required contributions tax, which needs to go to the tax authority, which is HMRC. So under payee, income tax in class 1 NIC payable by an employee is deducted by the employer from the employee's remuneration itself. This income tax in class and NIC liability together with class 1 and 1A NIC payable by the employer is regularly accounted for to the HMRC by the employer. Obviously, you need to inform the HMRC how much tax you have deducted at source itself under the pay as you earn scheme. The employer is obliged to make a full disclosure of the employee's remuneration, including the taxable benefits, to the HMRC. So very simply, we must inform the HMRC how much tax we have deducted at source under the pay as you earn scheme. Now, what is this tax collected at source basically? Tax collection under pay is more than just collection of source of tax at one rate. Through the use of appropriate software. So first thing you need is an appropriate software and the notice of coding. So you've got two things now. Tax is deducted at all rates after applying an individual's personal allowance, appropriate other tax reliefs, and even taking into account small amounts of employees' investment income. So what do you know? That this pay as you earn scheme is more than just tax being deducted at source. With the right softwares and the notice of coding, you basically devise everything pertaining to the employee's remuneration under the pay as you earn scheme itself. So now what is this notice of coding? How am I devising codes for my employees? Based on the information supplied in the employee's annual tax return, each employee is sent a coding notice that sets out, what is the coding notice that is going to set out? It sets out the allowances and the reliefs which the employee is entitled to enjoy. So it would set your personal allowance, it would set your allowable interest paid, it would set your expenses deductible from remuneration. The tax value of regularly recurring employment benefits, that is car and fuel benefits, small amounts of investment income on which it is convenient to discharge the tax liability by set off against allowances, so avoiding collection by self-assessment. Adjustments to cover tax underpaid in earlier tax years. The employer is not given the details of the coding notice. Only the code number is provided to the employer. By the code number itself, as soon as you feed it into the system, the payroll software knows what this code system number stands for and what to deduct, what level is the employee going to enjoy the benefits, reliefs, personal allowances. So what is this code number? To start off with, very simply, normally the value of allowances and reliefs exceed the tax value of benefits, investment incomes and prior year underpayments. So what you're going to consider, very normally, the value of allowances that you have, that is your personal allowance, and the reliefs that you enjoy, more or less are more than the tax value of benefits, investment incomes and any underpaid taxes. In such a scenario, which is more or less the normal scenario, the net allowance figure, let's assume it to be say 3099, is then what do you do with the net allowance figure? You divide that figure by 10 and then you need to basically suffix a number to it. So basically, very simply, how do I devise my code number? The net allowances figure, so let's assume it to be 3099 for example, is then reduced to a code number calculated as 1/10 of the net allowance rounded to the nearest whole number. The code number is used by the employer to determine the amount of the employee's pay that is tax-free. So very simply what you are doing, you are determining the code to determine the amount of taxable tax-free income that is going to be. So what is this tax code and how do I basically determine it? The tax number usually has a suffix letter that allows both HMRC and the employer to categorize the employees according to their PA entitlement. Most common suffix letter is the letter L, which indicates the normal threshold level of PA, which is £11,000. If the tax value of benefits exceeds allowances, so what you have to do, very normally what happens, let me just tell you what happens in a normal scenario for code numbers. You're going to look at your allowances and beliefs and reliefs and compare it with the tax value of benefits. You're going to compare it with the allowable interest which is paid. You're going to set it off with the allowable, where was I? Which basically meant I'm going to now look at my allowable expenses, investment incomes, and any underpaid tax. In most of the scenarios, which is the normal case, this value exceeds the other value, which means this value, which is £11,000 of personal allowance, exceeds the others. So when this happens, whatever be your net allowances value, let's assume it to be say 3099, you need to divide this by 10, which now becomes 309. And because this is exceeding the normal value, the normal suffix letter which will be suffixed is the letter L. So this is what in the normal circumstances happens. Now let's change the circumstances a little bit. What happens when your allowances are actually less than the tax value of benefits, investment incomes, underpaid tax? So in this case, what happens is that I now need to, if the tax value of benefits exceeds allowances and reliefs, the code will be a negative code, which basically means these codes are prefixed with the letter K. For K codes, only one is deducted from the final code number. The application of the K code means that an amount is added to rather than deducted from gross pay for pay as you earn purposes to ensure that the benefits are taxed at source. Very simply, let's take an illustration to understand this a little better. So what do we have? Assume that a basic rate taxpayer for 16-17 is personal allowance is 11,000 and other allowable expenses are say 415,000 pounds. So 11,415 is what I have at one side. I now need to compare it with the taxable benefits, any underpaid tax for that matter, which in this case is say 3,760,400 comes out to be 7,255. So very simply what I have, my personal allowances and my allowable expenses are more than the value of taxable benefits and underpaid tax. So this is like the normal scenario. So what you need to do first, you need to deduct what is the total, sorry, this is not this, comes out to be 4160. So very simply, what is the difference between the two? Which comes out to be 7,255. You divide this by 10, which is 725, and suffix the letter L because the normal personal allowance is what is applicable in this case. Now let's twist the case a little bit. Let's look at Example 3. Simon is a high rate taxpayer. He has company car benefits of £10,995. He underpaid £120 of tax in 14-15, which will be collected by adjusting his tax code. You now need to determine his PAYE code for 16-17. So very simply, what we do, we always start with the value of your personal allowance, which is £11,000. Apart from your personal allowance, you also need to add your company car benefit, which is given to be what? From this we reduce our 10,995. Also given is underpaid tax, which also needs to be reduced. Underpaid tax is £120. He is a higher rate taxpayer. So obviously this value comes out to be, divide by applicable rate, which is 40, comes out to be £300. So what is the net figure? Net figure is, let's see whether it's a positive or a negative figure. It's a negative figure, which means the value of your allowances and reliefs is less than the taxable value of benefits and your underpaid tax. Simply because it's a negative figure, what you do, you first divide this number by 10. Minus 1 to this number becomes 28, and you just need to round it off. Right, so 29 minus 1 comes out to be 28, and because personal allowance is less, we need to prefix the alphabet K. So simply the code comes out to be K28. In this case, just this code will be provided, which will be sufficient enough for the employer to understand what sort of coding needs to be done for the employee in order to deduct his taxable benefits value. What next? Now let's have a look at weekly or monthly procedures. At the end of each tax week or month during the tax year, the employer uses the payroll software to calculate the tax and NIC payable. Employers must report pay as you earn each time payment is made, which is that it needs to be deposited, it needs to be reported to the HMRC very much in real time. So it's known as RTI, which is known as real time information, needs to be submitted by the employer to the HMRC every time a deduction is made. On or before the due payment date, to an employee is made reporting the HMRC must be returned in a full payment submission, which is known as FPS, either using the employer's payroll software or through a payroll provider. Apart from very few exceptions, this applies to all the employers, and if not due date, if not submitted within due date, definitely penalties are going to arise if the full payment scheme, if the full payment submission, that is the FPS, is submitted late. Tax and NIC withheld by the employer must normally be paid to the HMRC within 14 days of the end of each tax month, 19th day of each month, or the 22nd if paid electronically. If average monthly liabilities are less than £1,500, then you can settle for quarterly settlement instead. What about year-end procedures? Every month or week you're sending a FPS. However, at the end of the year, you need to definitely submit an annual FPS. As an employer, you need to submit an annual FPS, which is giving away details of the entire year gone by of the employee. On or before the last payday of the tax year, the employer should make a final submission FPS to the HMRC. After the tax year end, annual totals of gross pay, tax and NIC deducted for each employee are shown in a form known as P60 and given to the employee to help him complete his annual tax return. The form P60 should also show the employee's name and address. These names are to be provided by 31st of May after the end of the tax year, that is 31st May 2017 for 16-17. So very simply, after the year end, you make a final submission FPS along with a form P60 needs to go from employer to employee, giving a details of everything pertaining to the employee. The employer also completes form P11D for each director and employees with taxable benefits not already reported on taxed under RTI. It shows the taxable value of general personal allowances, traveling subsistence, entertainment allowances and reimbursements, as well as benefits. An equivalent form P9D would be produced for lower paid employees, which would cover the items covered on by a dispensation agreed between HMRC and the employers are not included on the declaration. The due date for completion of both forms is the 6th of July following the end of the tax year. The employee must be given a copy to enable him to complete his tax returns. Employers now have the option of payrolling most benefits, in which case the value is included in the reported taxable pay and the employee's tax liability would be collected under the pay as you earn methodology. So very simply what we have at the year end, you need to submit the requisite forms, form P11D or form P9D. Where am I? Right. This needs to be filled in, which basically gives in all the details of the employee's whereabouts. Now what happens if in between the year an employee changes employment, which means the tax year is from the 6th of April 16 to the 5th of April 17, right? Now somewhere on the say 6 months down the line, which would be what? Which would be say from the October 16, I've changed my job. So if an employee leaves company A and joins company B, what happens to his payroll? How are things adjusted from company A to company B now? How the information about the employee's codes, pay as you scheme, pay as you earn methodology, everything obviously needs to be transferred from company A to company B. So how it basically happens? When an employee leaves, HMRC is informed through the full payment submission under the real-time information. However, the employee himself must be provided with the form P45 showing total pay and tax deducted to date of leaving together with his current tax year code. So what happens when you leave company A and join company B? Company A needs to make a full submission FPS to the HMRC and also provide the employee with a form 45. So form P45. So very simply what it is going to contain all the applicable information for the employee to be given to the employee. So now this employee can hand over this form P45 to the new employer to feed in all his data into his payroll software and therefore continue making the requisite deductions and payments. The new employer can then use this information to carry on deducting tax as if there had been no change in the employment. So very simply just the name of the employer changes from company A to company B. The software is the same for all companies. So what happens? The data just gets transferred from company A to company B. A new employee, however, will not have a valid form P45. Let's have a look at a scenario. Under this scenario, we were leaving one company and joining the other. However, so in this case, you obviously had a form P45. However, there would be few circumstances when you will not have a valid form P45, which very simply means that yes, you do not have a form P45. Under what circumstances? This job is not his first job since leaving full-time education. Obviously, if somebody did not have a job in this time frame because he was studying, so then who is going to provide him with the form P45? Also, he was previously self-employed, so there was no employer to submit a form P45. This job is in addition to his main employment. He was previously employed outside the UK. He has lost his P45 form. His last employment ceased in the previous tax year. So under all of these circumstances, you would not have a valid P45 from the previous employer. What do you do under these circumstances? How do you start making deductions? Definitely the new employer needs to feed all the information into the payroll system afresh. So he would collect as much as information he can and feed into the system and start making deductions at the initially applicable tax code. In the absence of Form P45, a new employer must gather as much starting information as possible and then be reported in the FPS and used to determine what tax code to initially apply. So very simply what we have what happens when dates are changing. Now that we've done NIC, we've done pay as you earn as well, we are now on the last topic, which is your self-assessment. It's extremely easy. Who does self-assessment on what and what are the applicable time frames by which these returns for self-assessment must be deposited with the HMRC. Individuals liable to income tax, Class 4 NIC and CGT are required to file an annual tax return and settle liabilities not already collected at source. Under self-assessment, an individual taxpayer is required in respect of each tax year to complete an annual tax return by 31st of October if the paper submission is made, or by the 31st of January if an electronic return is to be made following the end of the tax year. Then after submitting this paper return or electronic return, you need to calculate your own tax liability. That is what it is, why it is called self-assessment. You yourself are determining your tax liability, and not just determining, but after you need to settle this tax liability by submitting it with the HMRC within the stipulated due dates as well. Now taxpayers can still appoint professional advisors to undertake all the tasks except for signing the tax return and making the payment. Obviously, yes, you can take help of professionals and submit your returns because you're not an accountant, so you can take professional help. So how is this return completed? What does this tax return actually look like? So let's have a look at a tax return. Obviously, the tax return is going to first contain some basic information which would all be mandatory. Apart from this, there would be some supplementary information which is basically to support or to give detailed version of your basic information, to support basic information. And thereafter, you need to show a tax calculation working sheet. So very, very simply, this is what every tax return is going to comprise of. So let's have a look at each of these sections one by one and what it basically comprises of. The personal tax return comprises three elements, the first being the basic section, which all taxpayers sent a return must complete, showing incomes rising in the UK from investments, pensions and state welfare, claims for personal allowances, personal pension relief, and other reliefs, a declaration of compliance, and a statement of whether the taxpayer is or is not calculating his own tax liability. So these are mandatory as well as basic information. Let me quickly grab some water, please. Right. What about supplementary sections? Covering specific types of incomes, that is those from employment, self-income, immovable property. So basically you're giving a supplementary section to support your main figures. You're showing under each head how much income you have earned. After which, tax calculation working sheet, which would only be required for paper submission. Why? Because this would automatically be calculated if you're filing in your tax return electronically. So tax calculation working sheet for paper returns only, which the taxpayer uses if he is calculating his own tax liability. Now let's have a look at how to complete this tax return. Returns are issued to all taxpayers who are considered to require one. This would include higher and additional rate taxpayers, self-employed people, people with multiple sources of income, people potentially subject to a high income charge, benefit, child benefit charge. Any new source of income must be informed to the HMRC within 6 months of the end of the tax year. Obviously, the HMRC must be informed if you've started getting a new source of income within the end of 6 months of the end of the tax year. The taxpayer can correct or repair his return at any time within a period of 12 months following the prescribed filing date, which means that if you've now finally realized that there was an error in your return, you can actually repair it within a period of 12 months. You can actually correct your repair, you can repair the return which you have already submitted with the HMRC. HMRC will obviously correct obvious errors. Why? Because these are obvious enough, like calculation errors, simply calculation going wrong, or just numbers being twisted because of a typing error. Why? These are obvious errors which HMRC can correct on its own without having to ask the assessee to amend or repair his tax return. So HMRC can correct obvious errors at any time after the submission of the return. Taxpayer must retain records of used information to tax returns as follows. Persons conducting a trade or property letting business must retain all documentation must be retained for at least 5 years after the filing date. Otherwise, records needs to be kept for at least 1 year after the filing date. Now come to think of a scenario wherein you have failed to submit your tax return on time. Obviously, HMRC does need a tax return. So if you will not determine your own tax liability, HMRC will determine your tax liability, which is known as the system of determination, which now, because HMRC has been forced to determine, would not be appealable. You cannot appeal, you cannot fight against this figure unless you actually submit an original tax return yourself. So if no return is filed, HMRC has the power to issue a determination of the self-assessment and the amount of tax payable. Tax due under determination is payable without appeal, but the determination is suspended if the actual return has been filed. So very simply, either you submit a tax return yourself, if not, HMRC will determine your tax under determination, which figure of which you cannot be able to appeal against unless you actually finally now submit your tax return yourself. So what are these applicable time frames of payment of tax? For income tax and class 4 NIC, 3 installments are paid, the first installment being due on the 31st of January in the year of assessment. Second installment is due the 31st of July, following the end of the year of assessment, and the third installment, which is known as the balancing payment, is again due the following 31st of December. So very simply, for 16-17, what we have, first installment is 31st of January 17, second installment is 31st of July 17, and the third installment along with the first installment of the next year 17-18 would be 31st of January 18. So this is how income tax and class 1 NIC contributions are settled. For CGT, there is only one installment, which is the 31st of January following the end of the year of the assessment. So very simply, it always needs to be submitted likewise. Right. So now that we know these, let's have a quick look at an illustration. Right. So this illustration is extremely important for you. Make sure you know it, learn it if you cannot understand it. 31st of January 17. So for 16-17, these are the applicable dates. 31st of January 17, what I will do, I will make my first payment of account for 16-17 for my income tax as well as my class 4 NIC contributions. 31st of July 17, I'm going to make my second payment of account for 16-17 for income tax as well as my class 4 NIC. 31st of October 2017, I submit my 16-17 paper return. 31st of January 2018, I am going to submit my 16-17 electronic return. Also make final payment of 16-17 income tax and class 4 NIC contribution. Make the only payment of CGT for 16-17 and make the first on account payment for 17-18 for income tax and class 4 NIC contribution. So very simply, we have a timeline. 31st of January 17, what I do, I make my first payment towards income tax and class 4 NIC. Thereafter followed by 31st of July, where my second installment is paid towards income tax and my class 4 NIC. Thereafter, the following 31st of January 18, I make my balancing payment towards my income tax and class 4. Also the same date, this is the first installment due for the next year, which is 17-18. Also for CGT liability, a single pay installment is paid on the 31st of January following the end of the year. So I also settle my CGT liabilities. Between, if I am making a paper return, comes the 31st of October 17. If 31st of October, if I am making an electronic payment, the same 31st of January is when I am going to also make my electronic payment of my tax is also going to go through. Now, any repayments of tax arising under self-assessments are usually dealt with following submission of the tax return. The taxpayer who submits their paper returns on time can ask HMRC to calculate their tax liabilities, because you do not have the expertise to do it yourself. You're filing a paper return well in time. You can ask the HMRC to calculate the liability yourself. Those who submit electronic returns will obviously automatically their liability will be calculated by the system itself. Now, settlement of self-assessment through pay as you earn. A taxpayer who pays tax under pay as you earn has a tax liability due by self-assessment of under £3,000 can pay any self-assessed tax through pay as you earn by just adjusting the pay code number itself. So you need not make these on account payments. You can just adjust the pay as you earn code and submit these tax payments on account. The payment on account of income tax are normally each equal to half of the income tax plus class 4 contributions due by self-assessment for the previous tax year. So very simply what it is, I have to make these returns, right? I have to file my first installment is due when? First installment for 16-17 is due the 31st of January 17, sorry. Thereafter 31st of July 17, the second installment, and balancing payment is made on the 31st of January 18. So very simply we have these. What is the payment that I'm going to make here? This is my balancing figure. This payment is for 16-17. This payment is going to be based on my actual tax liability of 15-16. What I do, my actual tax liability of 15-16, I divide that by 2. In 2 equal installments, I make installment number 1 and installment number 2 to the HMRC. If at the end of 16-17, there is a balancing payment that I still need to pay to the HMRC, this is where the balancing payment is going to be made to the HMRC. So what it basically means that the payment of account on income tax are normally each equal to half of the income tax due to by self-assessment for the previous tax year. No payments on accounts will be required if either the income tax payable or the class 1 liability if the preceding is less than £1,000. So too less a figure to make installment payment. You can just make it in a one go. More than 80% of the income tax payable plus class 4 NIC liabilities for the preceding year was settled by the tax deducted at source. So if in the preceding year more than 80% of your total income, the tax has been deposited by source itself, then you need not make these on account payments. Why? Because the presumption is that at least 80% would be collected by at source itself this year as well. Reduced payments on accounts can be payable where under self-assessment for the current year is expected to be lesser than the equivalent preceding year amount. So this year, if I know that my income is going to be less than the previous year, thus my tax liability is going to be less than the previous year, I can simply choose to use my current year as my basis apart from the preceding previous year to be used as the basis of calculation of your installment number 1 and 2. The payment on account will be based on the current year rather than preceding year's figures. A claim for this must be made before the payments are due. Let's quickly have a look at example 4. Right, so what do we have here? 15-16 total tax payable was £9,500. Under pay you had collected £5,510, which is equivalent to how much? Which is equivalent to under 14-15, which is equivalent to, let's calculate how much it is equals to. £5,110 was collected at source itself. So which is equals to, let me just write the figures, 5510 divided by 9500 is equals to 58% of the tax was collected at source, which is less than 80%. So yes, I can use my prior year as the basis for calculation of my payment on account, the first and the second installment. This year what it is? Out of £10,500 liability, under pay as you earn, I've already deposited 5,880. Thus, it's not picking up the values. Thus, out of 10,500 liability, I've already paid 5,880 as my tax. So what do? The remaining £4,620 still needs to be paid to the HMRC. So what I need to do? I need to make payments on account. On account, first and second installment is going to be how much? Total tax payable, still payable is £4,220. I still need to pay to the HMRC total tax still due is 10,500 minus 5,880 comes out to be 4620, which is going to be made in terms of 2 installments. What I do, my first installment is going to be 31st of January 2017 is going to be based upon my prior year, my previous year. How much tax did I pay? I paid 9,500 minus 5,510. 9,500 minus 5,510. 3,990 I paid by way of installments. By the bottom was my balancing payment, right? So what do I do this year? I'm going to use this 3,990 as my base and pay it into 2 equal installments. First 31st of January and the second being on 31st of July 2017. The remaining. So how much have I paid? 1,995 here and 1,995 here. Thus my balancing payment out of 4,620, I still need to make another payment which is equals to 630 pounds. I'm going to pay in the 31st of January 2018, which is my last installment due now. So very simply, we've divided the total tax liability which I still need to pay in 3 installments based upon my prior year figures. Now let's twist the question a little bit. Explain the consequences if alternatively the tax paid under pay for 15-16 was 8,455, which means out of 9,500 total tax, 8,455 pounds was collected under pay, which simply equals to how much? Which simply equals to 89% was collected at source, which is more than 80%. So I can assume that this year as well, more than 80% would get deducted at source. So what I do not use prior year as my basis. But now what happens, because I haven't made any on account payments, what I now need to do is that the remaining 4,620 is going to be collected at source itself on will be paid. So this remaining 4,620 is going to be paid when? Is going to be paid, will be paid on the 31st of August, 31st of January 2018. Why? Because first 2 installments I am not paying. So this installment I pay nothing. This installment I pay nothing. However, the entire balance of what it is, the entire balance of 4,620 will be paid 31st of January 18. Why? Because I had presumed that more than 80% will get deposited, but only 58% was actually deposited under the pay as you earn scheme. Now let's assume, when we assume that the total tax payable for the current year is going to be only 8,000 pounds, which is less than my prior year. Because it is less than my prior year, I can assume my current year to be the basis of my payments. So what I do, out of 8,000 due, I have already paid. How much have I already paid? I have already paid 5,880. I have already been paid. So 2,120 is still due, which I am going to pay in 2 installments, each on the 31st of January 2017. I am going to pay 2,120 divided by 2. The second installment on the 31st of July 2017. I am going to pay the second installment, which is again 2,120 divided by 2. Now there is no remaining installment left. The entire liability has been settled. So 31st of January 18, nothing needs to be paid. Why? Because the entire tax liability has already been deposited with the HMRC. So very simply what we have, based upon how whatsoever figures are being collected at source, am I going to make payments under the pay as you earn scheme. On account payments for self-assessment are going to be made. Now let's have a look at self-assessment for companies. A company is required to calculate its own tax liability, submit an annual tax return and settle the tax liability by the prescribed date. All companies must submit their tax return online, which means there is no scope for paper returns in case of a company. You must have sufficient and adequate softwares in order to prepare your tax return online. Company HMRC will formally notify a company of the need to submit a self-assessment return. A company must file its return by the later of 12 months after the end of the cap and the 3 months after the date on which the notice requiring the return is served. So if you haven't submitted within 12 months, HMRC is going to serve your notice. After having received the notice, at least within the maximum of 3 months, you must submit your returns. Now remember, for companies we had a scenario wherein companies could have a long period of account which comprises of more than one cap. Now your period of accounts means your books of accounts actually are for a period which is more than a 12 months time frame. So how do you settle your tax liabilities for companies which have a large period of account? For long periods of accounts, returns must are submitted for each cap within 12 months of the end of the second cap, because both returns, that is the first cap which is 12 months and the remaining months, are based on the same set of accounts. Companies can prepare returns at any time within 12 months of the filing date. HMRC can correct obvious errors within 9 months of the actual filing date. Companies must normally retain records until the 6th anniversary of the relevant filing date. However, if the HMRC requires additional return before the 6th anniversary, that is, an inquiry has been opened up, then definitely you need to retain your records for a period of more than 6 years as well, till the time the case actually, till the time the inquiry actually closes. If no return is filed, HMRC can issue a determination, which again would only be stopped when the time an actual return is submitted with the HMRC. So like for individuals, the case of companies is also quite similar. Now when I am filing an electronic return, how do I follow it? How do I prepare it? What would happen if each company would follow their own methodology of preparing this tax return? Definitely none of these methods are going to be uniform. So what it is that the HMRC has issued a format, and this is the only allowable format in which you can submit your tax returns. So tax returns of all companies must be filed electronically using standard electronic format known as Inline Extensible Business Reporting Language, which is IXBRL format. This format not only applies to tax returns and computations but also the accounts submitted with them. So even the supporting documentation, the supporting accounts which get submitted to the HMRC is also going to be embedded in the IXBRL format. The IXBRL is a worldwide standard electronic language which applies computer readable tax to business data. IXBRL means that accounts and tax computations are prepared with embedded computer readable tax, which secure payment, fast and rigorous computer analysis of the data contained in these documents. So very simply, what is an IXBRL? It's a computer embedded language in which you need to submit your returns. Not just return, but with your supporting accounting records also get submitted in the format of IXBRL to come to the HMRC. IXBRL is based on dictionaries called taxonomies. These can only come in MCQs maximum. Don't expect a theory question, but yes, little questions based on MCQs can be asked. The taxonomy specify the tax required for analyzing the accounts and computations for UK tax purposes. We've got 3 taxonomies which are valid taxonomies. 2 for tagging the accounts either under UK GAAP or UK IFRS, and 1 for taxing the return and the computation. So simply we've got tags, which is known as under taxonomies. We have tags which are going to collect, which are going to tag your returns as well as your supporting accounting records. Companies can comply with IXBR rules by either computer and software issued by HMRC, or you can take one of the bespoke of softwares which are available, which would definitely needs to comply with the requirements of the HMRC. Now, what happens for payment of corporation tax in case you are a small company? In case a small company basically means that your profits are below the threshold level of 1.5 million. So, you're a small company if your profits are less than 1.5 million. In this case, what you do, you're allowed not to make installment payment, but after the end of the year, you can wait another 3 months and start making your payments of the previous year in 9 equal installments, each being equal to 1/10 of the tax which is totally due. So for companies with profits below the threshold level of 1.5 million, corporation tax payable is due 9 months and 1 day after the end of the cap, which is for year ended 31st of December 16. Your relevant date is going to be 1st of October 2017. The threshold level of 1.5, which would be given to you in the exam, is going to be reduced proportionately for short periods of accounts, and if it is a group of companies we are talking about. Group means that as long as the ownership of the parent company on all of the subsidiaries is at least 51%. So supposingly there are 3 companies in the group, then this limit of 1.5 million gets divided by 3, and that is the applicable limit for each of the companies to be categorized as a small company. Companies are 51% group company if one of the subsidiary of the other, that is, or they are both the subsidiaries of the same companies. Similarly, we also have a concept of large companies, which obviously is above the threshold level of 1.5 million. So this threshold level of 1.5 million that you have, if the profits are below it, you're known as a small company. You can make your 16-17 payment in 17-18 by making 9 equal installments after the end of 3 years, which each of which are going to be equals to 1/10 of the 10% of the original of the previous year 16-17 liability. Also, if it is above this threshold level of 1.5 million, it is known as a large company. So what happens if you're a large company? 1500 million corporation tax liability, usually quarterly, where the first installment is due 6.5 months after the start of the cap, and the last installment is due 3.5 months after the end of the cap. So very simply, if you're a large company, you need to make these on account payments, which means that for a 12-month accounting period, 4 installments are going to be due. The first being on the 7th month of the cap, the second being on the 10th month of the cap, the third being the first month following the end of the cap, and the fourth being the 4th month following the end of the cap. For other accounting periods, the number of installment would determine on the length of the cap as follows. So if you have a time frame, the length of the cap is more than 9 months but less than 12 months, so you're going to have 4 installments. If between 6 to 9, you're going to have 3 installments. If between 3 to 6, you're going to have 2 installments. And if between less than 3 months, you're only going to make 1 installment payment. All installments except for the last one are based on the estimated tax liability calculated by the company towards interest charges, but these must never be understated. A company that becomes a large company for the first time or requalifies to be a large company will escape quarterly settlement if the profits for the relevant cap are not going to exceed the threshold level of 10 million and it was not a large company in the previous cap. The 10 million limit is similarly restricted by the number of 51% group companies and or if it's a short accounting period that we are talking about. Simply what do we have? Based on the time frame of your tax frame of your anomalies, you're going to determine the amount of tax, the number of installments that you're going to pay. What is the claim for tax relief? Now these claims for tax relief you can make. The procedure must be that the claims must be made in writing within the specified time limit unless they are required to be included on the tax return. Claims for capital allowances, personal allowances and reliefs and groups and group relief, all of these claims, any sorts of reliefs, any sort of allowances that you are claiming must be made in the self-assessment tax return. Obviously, HMRC is not going to dream of as to what is the amount of limit that you're going to have or what is the amount of claim or relief that you're going to claim. You must inform the HMRC. Time limit is unless a specified alternative time limit applies, all claims must be submitted within 4 years of the end of the relevant cap or the tax year whichsoever it may be applicable to. Now that brings us to an end of this chapter. We've done all the requisite rules for NIC. We've done all the requisite rules for pay as you earn. We've done all the requisite rules for your self-assessment. Remember, not a very difficult chapter. It's a very small topics. So you can be asked a maximum of a 4 marker on this chapter or it can come up in your MCQs. As usual, absolutely any query you have, you can always feel free to email it to me at Shilpi ACCA@gmail.com. That's it then. Thank you very much for today's session. Thank you.